Did you guys get these basic examples? Did you guys get these basic examples about transfers? I mean, this is in your homework, right?
Yeah.
So, you want to see one example of one of these? That I do it on the board?
Yes, please.
Okay. I need a good looking assistant to do this. All right.
Exchange transaction.
Exchange, all right. Central bank, 1, central bank 2, okay. So the first thing that's important to pay attention to is that a balance sheet is always in a given currency. Okay, a balance sheet is always in either dollars, euros, bitcoins. It can be in whatever currency, but it's always in one kind of clearly defined currency. So I cannot mix and match here different currencies. If these assets are comprised of assets denominated in dollars and in euros and in pounds, then I would enter the value of the pounds and euros in dollars in here. So everything would be in the same unit of measurement. Okay? So maybe these are 80 pounds, but I'm writing here $100 because, sorry, in euros, because this balance sheet is in dollars. And that's the most important thing to start with when you're doing these T-bills. And then you just have to remember the exchange rate. So for simplicity, let's say that even that this is a European bank and it's allowed to have an account with the ECB, but it doesn't really have an account with the Federal Reserve unless this bank has also a subsidiary in the United States having a US banking license. Okay? So let's say Bank A has a subsidiary which has a banking license in the Federal Reserve, so we can also put Bank A here having 0 and Bank B saying it's an American bank, but let's say it has also a subsidiary in Europe that has a separate banking license issued by the ECB, then it's allowed also to open an account here. Otherwise, there's an additional complication introduced, which is also in your homework, called the correspondent bank. I'll let you figure it out. And so this is the beginning situation. All right, and now let's say that they exchange €1 for $1. Okay, and let's say that's the exchange rate, because that makes it simple. And then Bank B had €0, but now it would have €1, and Bank A would have €99. And here Bank B would have $99, bank A would have $1. Okay, so this is just like the example with the black rocks and the white rocks on different islands, that they've exchanged them, but they said, you know what, you don't need to ship that big stone out to this other island because you're probably gonna drown along the way. Just leave it on that island and put the little sticker with the name on it. Just change your name, take your sticker out and put my sticker on there. And I'll do the same. And then the money can stay here and here. And the money does stay. Okay, money never leaves the liability side of the central bank. Okay, does this make sense so far? Good. And so, and just if the exchange rate is 1 to 1.15, to 1.1, so 1 euro is $1.1, then this would be $1.1, and this would be 1 euro. Right? This guy sold 1 euro. Bank A sold 1 euro to Bank B. So now told the ECB to transfer 1 euro from the deposit account that he has. He had 100, now he has 99. Where'd that one go? To Bank B. 1 euro. And at the same time, Bank B told the Federal Reserve to send $1.1 from its account with the Federal Reserve to Bank A. And now the 1.1 went here. Okay? And the point of this is to make it explicit that how things work, and also to kind of, because people their entire careers in finance have in mind that money is kind of traveling internationally and goes and gets processed and then reaches. Okay, but this whole kind of metaphor and imagination is false. So apart from knowing the basic mechanics is also to kind of dispel these kind of notions that people carry around in their mind. Is this okay? All right. So sorry about not having so many examples, but you get solutions for the homework. They're good solutions. Anything else from the homework from last week about the exam? Anything else I can do for you? Okay. Is better? Oh. So I just want to get back to the end of last class when I was giving you this. Okay, it's a matter of judgment. Okay, when I was comparing the beer's monopoly to the current system of money that we have in every country, this is an example. Okay, it's not a proof that you have monopoly power in the banks, which has negative consequences. Okay, there is no such proof. It's a matter of judgment, and I wouldn't contest it. Okay, anyone in my position or similar position trying to do business and has to move money is confronted with the bank's monopoly. So I wouldn't try to dispute it, but still I cannot prove it. So again, this is not part of your exam. There is not going to be any question in the exam about this kind of what is a call of judgment on my part to try to convey to you that there is monopoly power out there in the banks. So the exam will be very similar to this. Okay, so the whole course is factual. The exam is going to be very close to this. And yeah, it could have been nicer if I had like 20 additional examples with solutions and you could memorize them and yeah, all right, but it's not gonna be like that. But you'll have enough examples. So I do want to kind of finish this, maybe not go into all of these details, but it's important to me because what I got the feedback from you guys and what I remember and what I know in academia and in the regulatory world is that bank runs and systemic importance of the banks and the regulatory regimes that in Basel they try to impose on them to make sure that they don't collapse and bring down the economy. This is such a huge thing that I just find it necessary to bring the other side of it, which there are. The other side of it is that banks have huge monopoly power, a lot as a result of these regulations to make them safe. And the second very important point that very few people really get is that you can introduce competition to the banks in payments, okay, not in depot accounts or other things. You can also do that, but what I'm showing you is just competition to the banks in the most simplest forms, okay, in payments. And maybe that's gonna take away a lot of their monopoly power, maybe just a little bit, or maybe it will be kind of shown that they have no monopoly power, so this doesn't really make a difference. But I definitely think, and it's factual, that this is much cheaper to build and open up than a bank, okay? So these, what I call a CBDI or an e-money licensed institution or a narrow bank or what's it called, a safe bank. These are different names to the same thing. This is a bank that all it's allowed to do is to take deposits from the public, give them their IBANs, and with this money, it's not allowed to do what banks are allowed to do. It's not allowed to lend it out. It's just allowed to deposit it with the central bank, and that makes it credit risk free and 100% liquid. And again, the point is not to force the banks into such a narrow model of business, because we need banking, of course, that's what we do around here. And the point is to have this as an additional license, so then these smaller institutions could pop up, and they do where this is allowed. They pop up very quickly and allow people to do basic payments without the headache of having to go through bank compliance, and without the headache of having to negotiate with a banker, without the headache of having to pay a lawyer to introduce you to that one banker that does let people open accounts. All these things are extremely problematic. But then again, it's not factual that there is indeed such monopoly powers in the banks. It's a matter of judgment, so I can't prove it, but take my word for it, there is huge monopoly power in the banks, and these things that I'm trying to convey to you, like the magnitudes of their balance sheets, okay? So there's two large banks in Switzerland, UBS and Credit Suisse. Each of them has 1 trillion francs on balance sheet in assets, okay? That's a lot. That's more than the central bank, actually. The central bank has about 600 billion, and they have 1 trillion each. Okay, so these are huge monsters. How could they not have monopolistic power? And so this we've discussed, and I want to discuss with you is the additional step is that, okay, I've been saying that, yeah, if you have more competition in payments, then it's easier for you, it would be easier for you to open an account, and it is, because the banks just, they don't let you really open an account unless you're a very simple kind of individual and citizen doing very simple business. Anything cross-border, is usually kind of refused unless it's very profitable for the bank. So apart from that, if enough capital would migrate to these basic payment services and wouldn't have to finance the banks, right? Because if you have your money on deposit with a CBDI or e-money licensed institution, because you're not interested in the other services that the bank has, such as securities and everything is kind of integrated, and maybe you don't need that because you just want to make payments, you don't even want to keep the money in the account, you just need to transfer it back and forth, then you say, well, let's do it with a e-money licensed institution, then you wouldn't be financing the bank. And then let's say if enough people wouldn't finance the banks, then maybe their monopoly power in what's really the problematic case would go down. And the really problematic monopoly power that the banks have is in asset generation. Okay, when they have so much of the public's deposits at their discretion to lend out however they wish, well, not exactly, they're under regulation, so it's not exactly however they wish, but however the circumstances dictate, and they have the discretion how they're going to lend yours and our deposits, then that means that there is huge monopoly power in which assets get generated, which loans get given out. Okay, and that's the real kind of having the macroeconomic effect that's changing our economy and changing the world, but you can't really see it, you can't really feel it because you don't know how it would be without it. So again, we're going into the realm of theory, which this course is not about, that's why this is not in your exam. But again, I feel it's such a huge thing that any businessman in finance, and any businessman period, is having to deal with this. That, and on the other hand, so many people that call themselves academics, economists, regulators, central bankers, and so on, are obsessed with always seeing it in let's make the banks safer instead of just having this additional option for payments. Then I think it's a good kind of counterbalance and very necessary. And you can go through all this and see these are kind of a collection of my kind of anecdotes, why and how difficult it is with the banks. Yeah.
I have a question.
Yeah.
Indirectly about Fall2018.
Yeah, we're getting there.
If it would have been accepted and
Right.
we would no longer have banks but CBDI, wouldn't there be like the problem for the poor people because they can no longer afford like a hypothec or a loan for a car because the interest rate would go up way high because there's less money?
Right, so let's try to break it down. It's not, I don't see it exactly like you see it, but let's try to break it down. I definitely agree with you that they were foolish in their proposition. Very foolish in their proposition. Okay, so let's first say in Switzerland you've had this year a referendum for something that they've labeled the Vollgeld, the full money initiative, and in essence they wanted to say that they wanted to pass a law that would force the banks to be able to do only one thing with the client's deposits, which is to deposit them with the central bank, just like I proposed for the CBDI. Now, it would say, it wouldn't limit what they can do as far as lending with money that they've raised in the bond market, okay, for example. So the banks would still be able to borrow money in the bond market and lend it out to companies and individuals as they see fit, but just the money that they're taking from the public and deposit, this they would have to just deposit it with the central bank, so it's always liquid and always safe. Now, it's problematic and it's not the right thing to do, in my opinion, because of what Omar was saying here, and similar along these similar lines, they were trying to force something on the banks, okay, to limit their ability to lend the money of the depositors. They would still be able to lend the money from the bondholders and other types of financing and liabilities that they have, but just not the deposits. And that would make the deposits very safe, and that was the original idea behind these guys who are very stubborn academics, and but they didn't take into consideration several things. So one is that this would apply to all of the banks, okay? So this would get rolled over onto the clients directly, because you would come to open an account with a bank and they would say, you have just a B permit? I mean, why we don't let you open an account? Oh, you're not even a resident here? We don't let you open an account. Oh, you know, it's not so profitable for us to let people open accounts. How much money are you gonna have on deposit with us? Oh, you know, what kind of business you're gonna do with us? Oh, that's not so profitable for us. You know, we don't do that anymore ever since the law was passed, had it been passed. So this would increase their monopoly power to the moon, and it would be more than fully rolled over onto the clients. And so that's the one thing. The other thing is that it would be a huge kind of adjustment that's necessary for the banks, because right now the deposit base is mostly lent out as hypothec. Okay, so they would have to adjust their entire balance sheets, and these are huge balance sheets, and I don't know, they would need an adjustment period of at least 2 or 3 years to sell enough bonds to replace the deposits, and that would have huge and unexpected effects. Or maybe it would go smoothly, but anyways, it's too big of an experiment. And the main point is that this is totally unnecessary to impose such an additional restriction on the banks, which would only increase their monopoly power, when if they understood how money works, then they do. I talked to them. It's just that they have some kind of organizational problem. They don't have like a clear leader that knows what's the right thing to do, and they just bicker with each other. That's my judgment after speaking with them. If they fully understood that all they could do to alleviate this problem is to allow this additional license, which exists in many countries, okay? In the UK, in Malta, in Lithuania, like I said, you have this e-money license. This thing exists. I didn't invent this. To have an additional license, it's not a banking license, but it's an e-money license, and then it allows exactly this model like I explained, and then people could choose if they want just simple payment services because they need their IBAN to accept money and send it straight away. They don't have a need for other banking services, they just need payments. Then maybe they could choose to work with a CBDI if it works for them. But if they need a bank, then they can stay with the bank. Okay? And this kind of additional choice makes a lot more sense. And going back to this slide that I skipped, that yeah, if enough time passes and enough awareness to this additional depository option and enough money, especially retail, we're retail clients, if enough retail money migrates on its own accord to credit risk-free and liquidity risk-free CBDI instead of a bank, then you can safely assume that most people who wish to deposit with the CBDI are with the CBDI, and most people who wish to stay with the bank stayed with the bank, and then you can ease off some of these regulations on the banks, especially as regards the insurance of depositors' money. Okay, so maybe you can let the banks fail, or maybe you can let the banks lend as much as they want and not have so much liquidity constraints imposed on them, because Well, if you stayed with the bank, when you have this other option to deposit directly with the central bank via an e-money licensed institution, then maybe you're doing this for other reasons and you're grown up and can take the risk. And then you don't have to have insurance. You gotta think about it. This kind of negates a lot of what is out there as regards regulation and bank runs. True, banks are susceptible to runs because they're allowed to lend out the money of the clients. But the central bank is not susceptible to bank runs. Okay, you have to read that article. I'm not going to go through all that. It's a bit of a hard explanation, but it's a fact that the central bank is not subject to any bank run. That can never happen. So I think this is extremely important. You may disagree with me as regards to exactly how much monopoly power these banks have. I mean, you probably don't feel it. You have a bank account. You never were questioned about money coming in or going out from your account. But I run a business that does cross-border payments. I run into serious problems almost every transfer, and I'm limited in a huge way. Okay? And there's the matter of the unfair scrutiny. So wherever you do have these e-money licensed institutions or payment service providers that if they work on the infrastructure of a bank, or if they're allowed to deposit directly with the central bank, in any way, at some point, they get scrutinized more so than the banks as regards their transfers, to make sure that there is no money laundering going on in these transfers, that these transfers don't constitute money laundering. They get scrutinized, and this is judgment of mine, I cannot prove this, but they get scrutinized 10 times more than the banks. Once you have a bank account, you can send money to Mickey Mouse. But these CBDIs, they get audited by the regulator about every payment almost, much more than the banks. But I can't prove this, and this is just a matter of my experience and my judgment, so of course this is not for the exam. And, take it with you, and I want you to keep this with you as you go through the world of finance, because you're going to see this everywhere. Any questions about this before we move on to the next topic? Yeah.
Do you think companies like PayPal will open CBDIs themselves?
If there was such a license in the United States, which there isn't, then you would have many such companies such as PayPal and much smaller competitors, because it's much simpler and cheaper to open a simple CBDI than to have the whole infrastructure that PayPal has. PayPal is a huge organization. So PayPal would surely have it, and much smaller and new competitors would get it because it's not such a big deal. Literally, 3-4 guys with IT knowledge can set it up and get the license within 3 months with an investment of maybe $150,000. Yeah.
So,
Yeah, let me just finish your question.
so if I understand it correctly, by having a CBDI, you kind of walk around the banks?
It's like a bank, only it's very limited in what it can do to just these very basic, you want an account, you can have an account. You want to make payments, you can do payments. That's all you can do with it. And then it's quite cheap to set it up, quite simple. The main thing that makes it cheaper is because it's risk-free, credit risk-free. They cannot lend the money out and then lose the money, and therefore they need equity against future losses because they're not allowed to lend it. And because they don't need equity, then that makes it cheaper, because if you lock up equity, then you're not making interest on it. That's the cost of equity. Okay, the big reason why you don't see so many more banks is because you need at least 10 million to open a bank.
Yeah, okay. And are they utilizing what's in place by now? You said in some place in Eastern Europe there are
Yeah.
some channels.
check out in Lithuania, they're popping up like, a lot of them are popping up. And it's working really well. They took maybe 30% of the payment volume in this small country called Lithuania. And they are not free of trouble. Like I said, they are getting scrutinized to an unfair level right now. I don't know if you heard, but there was something in Estonia and in Latvia where the central banker in Latvia was taking bribes from some Russians to allow them to move their black money outside of Russia. And also in Estonia, this Danish bank facilitated billions of dollars, hundreds of billions of dollars worth of black money payments, and nobody scrutinized this. And as a result of this, well, this bank in Estonia, it's a Danish bank in Estonia, got caught and got slapped with a huge fine by the regulators in Denmark. But as a result, these small institutions and the regulators in the Baltics, in Estonia, Latvia, and Lithuania, they got very nervous because it happened already in the past that they got caught doing this Russian business, and they were punished by the European community and the US community as a result. So they want to preempt that by making sure that all the transfers that goes through these institutions, the banks and the CBDIs, are squeaky clean. So this is right now going on. And because the banks are so big and there's so many transfers going through the banks, then the regulators say like, well, forget about even the banks, let's scrutinize the small new ones. So they're scrutinizing the small new ones to a much higher degree, and this is my judgment because I have accounts with both, than the banks. Okay, so right now maybe it's not so easy to even open an account with the CBDI in Lithuania because they've made it stricter because they're under the scrutiny. And this goes back to what I taught you about how money works, this structure of everything being centralized on the central bank's database and then pushed down one layer to the bank's databases. It means that every transfer that's ever made is subject to monitoring ex ante or ex post. Okay, they don't monitor everything ex ante, but if your account is flagged, if they had half an eye on your account, they can have now 70 eyes on your account and check the entire history. Okay, and just this knowledge, and our next slide is about Bitcoin. We're going to talk about Bitcoin. I want you to keep this in mind because this is a really nice point to carry with you from this slide to the next slide about Bitcoin. That every transfer in every fiat currency that you have is subject to monitoring and rejection. Okay, ex ante and ex post. Okay, many of your transfers, perfectly legitimate, will be refused because they just might be, because in the past something that looked like this is just simply not allowed. And you're not allowed to send money to a third party in another country. But maybe it's legitimate business. But you are allowed if you're a big enough account and you're working with the bank. So there's this thing called huddling, okay? Crowding. People are hiding in the big banks, okay? Because if you're with a small bank, then there's nobody else in the small cantonal bank, and Graubünden or whatever, that's doing international business. So you don't want to open an account there because they'll stop your payments. They wouldn't let you do the international transfers because it would just look too scary for them. But you want to open an account with UBS or Credit Suisse because they regularly do international business, then you're kind of hiding there. And you can do it. Whether you're a legitimate business or illegitimate business, you want to be there. Because there's enough others that are doing this business, then they let them be. But if you were trying to do this via CBDI, where it exists, or via a small bank, most likely you would be refused to begin with. Even if it's legitimate business I'm talking about. So, and everyone wishes they would have an account with one of the big ones. But the thing is, you walk into one of the big ones and they say, how much money am I looking at? All right, and it's not even explicit. They would come up with things like, oh, I heard Deutsche Bank. Right? You have to have 5 million on deposit if you're a business that's doing international transfers, and only above that you can send money in and out. but you need 5 million to just lie there to finance them for free. So why don't they just tell you, well, it's about 5,000 or 10,000 a year to keep your account, but then you don't have to lock up 5 million. They don't say that because it's not seemly, doesn't look right that they would charge you 5 or 10,000 just to have an account, because people would kind of stand up to this. So they put up in other ways how they can make money off you. So it's a very convoluted kind of everyone trying to push and pull their own way to make more money, and it starts with having an account. Okay? And the real big problem is in asset generation. As a result of everyone having to be and wanting to be with the bigger and bigger banks, then you have huge monopoly power in which assets get generated out there, which loans get issued. And the point is that small loans to individuals and small loans to real estate developers and small loans to small companies don't get issued, but huge loans to big companies do get issued. Okay? So if I'm an investment banker and I have 100 million balance sheet of the bank that I can lend out, I'm gonna lend this to 2 or 3 big companies because I'm gonna get a big bonus for giving out 30, 40 million loans to big companies. I'm gonna get a big bonus in the bank. That's how it works, because I brought big deals to the bank. I'm not gonna hire now 100 credit officers to give out small loans to individuals at 10%, even that it's more profitable maybe, because then I can't take it because it's not a huge deal that I'm bringing to the bank. It's a lot of small profitable deals, and that's not so interesting. They wouldn't give me such a bonus for this. Okay, so this is another element that's out there. Again, this is not factual, this is not something that I can prove to you, but you're gonna have to go through your banking experience, and then hopefully you're gonna go through your independent financier or working for a smaller firm, trying to move money more flexibly, then you're gonna see it even more. The banks simply get in your way from doing what you want to do. Maybe someone can help me find my next presentation.
I think it's a break anyway.
It's a break now?
Yeah, 1 minute.
Any other question before we go for a break? Yeah.
So it's only in Europe you can get a license for CBDI?
You have an e-money license. There's 2 types of e-money license. Okay. Again, one is in the ability to take deposits from the public and give them their own IBANs. That's one side. And the other side is being allowed to deposit directly with the central bank. In Lithuania, it's such a full license. But in the UK and in Malta, where you also have e-money license, probably some other places, but that's where you have, where it's popular, they're not allowed to deposit directly with the central bank. They're allowed to give clients their own accounts and take deposits from the public, but then they're forced to work with one of the banks to have one account for all the clients, and then using sub-accounting to keep track of which client has how much, but then every client has their own IBAN. So it's half a license, and then it's half as good. Where it's really full, and you can really bypass the banks, then it's really working the best. Okay, thank you guys. So let's talk about Bitcoin, but we're gonna keep it to the accounting facts level. Okay, that's what I want you guys to take from this. And yes, there's one issue about whether your transactions can be stopped by the bank or refused. Okay, nobody can stop you from sending your Bitcoins to anyone else, and that's one of the benefits that this has. But it has also several drawbacks. We can discuss them, but before we do, let's talk basic accounting facts. Bitcoin is in positive net supply. Okay, that's important. It's just like gold. There's a certain amount of it out there circulating, And who has these finite amount of bitcoins, this information is kept on what they call a distributed public ledger. Distributed means that it's not kept on one database like the central bank database. It's kept, it's an this data file is kept on many computers all over the world, and the technological innovation of it is that this data file and the entire history of who had how many bitcoins at what point, the current state of affairs, and also the entire history of who sent how much and how it got to be to this state of affairs, that this wallet has so and so bitcoins and this wallet has so and so bitcoins, is contained in one file, and this file is identical in all these hundreds and thousands of places all over the world that it's kept. This is the technological innovation. Okay? Try to think, and I don't know how to explain exactly the technological aspects of how this is really accomplished, but I can illustrate the challenge in this. So let's say this is my wallet, and this is your wallet, and I've decided to send you, I don't know, this 0.135 bitcoins from my wallet to you as a thank you for something. Then, okay, if this database is kept by me, only on my computer, then I can do that. But if I told you that this database is kept on many computers online, and that they all, then the challenge would be how to reflect this transaction now in all of the databases at the same time, and that there wouldn't be double spend. Double spend meaning that it shouldn't be allowed, otherwise this whole thing is not useful and doesn't serve its purpose. It shouldn't be allowed that I would send the same Bitcoin to both of you, right? So if I give you the 0.35 and then I send you also the 0.35, and I can do this before it gets updated on the other files where this information is kept, then the whole thing defeats the purpose, because then the number here grows and okay, and there's no control over it. So it has to be that if I'm sending one Bitcoin from this wallet to this wallet, it has to be reflected in all the files at the same time. Okay, and this is the technological innovation in this, which I cannot fully explain to you because it's beyond my technical knowledge, but you just need to take it for granted that there is no one place like the central bank where this information of how many bitcoins are in each wallet, there is no just one place. It's kept in many places and you cannot cheat the system. Okay? There was a guy that called himself by the nickname Satoshi Nakamoto that wrote a white paper. It's most likely Australian Dr. Craig Wright. I almost worked with this guy, but I ended up not working with this guy. And this is kind of a print screen of the world's richest wallets. Okay? The point is that this wallet, this ledger is public. Okay, so how many bitcoins are in each wallet and what is the total number of wallets out there, because you can open many wallets. This is public information. What is private information, what is private is who owns these wallets, okay? It's coded, so you don't have the name next to it, it's just the number next to it. But the big ones, it was made public by whoever owns it. In this example, this wallet is owned by Bitfinex. Bitfinex was the world's biggest Bitcoin exchange, and they keep one wallet for all of their clients' Bitcoins go in this wallet. And then they keep sub-accounting for how many Bitcoins are owed to each client, just like the banks. but then they keep all of it in one wallet, and they've made public that this wallet is theirs, and this was the richest wallet in the world. Now if you look, and this is from 1 year ago, but if you look at the current one, then the top 10 or so richest wallets are all owned by the exchanges. So people have their bitcoins on the exchange because they might want to sell it to someone else, so they just keep it on there to a large extent, as opposed to keeping it in wallets which they control directly. Okay? And this arrangement is called a custodial arrangement. It's a custodial relationship. So just like when I deposit with the bank holds this money in custody for me. It's a custodial relationship. The same thing with an exchange, with a Bitcoin exchange. They're holding my Bitcoins in custody to my benefit. Okay? These wallets, a wallet is controlled by the person holding the private key. An outgoing payment can only be approved by the person having the private key. All right? That's really the basic and one and only functionality that these things have. So, of course, just like any hype, and just like anything that has to do with money, and is all of a sudden kind of coming into the consciousness of people, and also on a constant basis, everything that has to do with money has to be so mysterious and complicated because people make it so mysterious and complicated, and they hide the fact that there's only one thing you can do with a bank account, which is to receive and send money, and there's only not one thing you can do with bitcoins. You can either keep them in your wallet or send them to someone else. There's only credits and debits in finance, okay? Yeah, you need a private key to be able to send money out. You don't need anything from the receiving person to send it to him. So I can send you Bitcoin, and there's nothing you can do to stop it from entering your wallet. If you don't like it, you can send it back. So if you think that I'm trying to trick you and this is black money, and I'm trying to, incriminate you, and you don't like this Bitcoin, you just send it back, and you write a little settlely saying that you've received this Bitcoin, but you've sent it back, and you've refused to accept it. And then, if the FBI comes to you, then you just show that you sent it back, and then you're clear. But the point is that you cannot refuse an incoming Bitcoin payment. So really sending a Bitcoin is you just put the receiving address and the amount. There is the issue of the transaction fee. We'll get to that a bit later. And what's out there is that they came to be, just like this print screen, wallet service providers. Okay, to really interact with this file that's kept on many servers all over the world in the right way, like the technology dictates, is not a simple thing. Okay, it's not something that you, unless you're a computer scientist and have sat down and read this, be able to do on your own. But there's plenty of computer scientists out there that can figure it out for you, and what they'll have is they'll set up a user-friendly kind of GUI for you, GUI. What does GUI stand for? I forgot. GUI. Someone here from computers? Yeah. Graphic user interface, a little GUI for you. And on the back end, they've coded what is necessary to really interact with this file called the blockchain. Okay? That's this 4 megabyte, or I don't know what it is now, 8 gigabyte file that contains the entire history of how many bitcoins were contained in which wallets, and all the transactions that went from different wallets to bring us to the current situation of these wallets having these amount of bitcoins. And again, it would be, so you would log in with a username, a password, and two-factor authentication, but the actual private key is a series of, I don't know, 21 digits, I think, that would be kept safe by the wallet service provider. So again, you need to trust the wallet service provider with your private keys. So again, it's a custodial relationship. Now, it's not a bad thing. There's plenty of companies out there that you can trust them not to steal your bitcoins, because this would be a criminal offense, and their entire business is to enable people to do this very basic thing. So probably they're not going to one day steal your money, but this has happened. This has definitely happened, especially in the early stages where things weren't so regulated and so self-regulated. So like if you see a wallet provider that's already enabled millions of users, then it's kind of self-regulated that this thing works and they're not going to steal your money. But if it's something very new and you don't know. And there's no message to receiver field. You don't have this message field. But if that is necessary, then you have to kind of work your way around it. And maybe, because it's free and quick to open another wallet, so maybe if you need separated accounts, because then you set up another wallet for this. We'll discuss this in a minute. Some features, just about the quantity. So the current quantity is 17,300,000 bitcoins out there, and this quantity is deterministically going to 21 million. Okay, so it's right now at 17 million. It started at lower, and it's going at a deterministic rate, and it's going to be capped at 21 million in the year 2140 or so. Okay. So is it good, is it bad that this is the amount, that it's finite? It's possible that the economy would use this as money additionally to what currently serves as money. And it's a fact that some people are using this to make payments to each other. Is it good, is it bad? Let's not go too much into it. It's divisible up to 8 places after the decimal point, but please round it to the nearest Bitcoin cent for me, okay? It's divisible after 8 places, so even that there's only 21 million, if Bitcoin was really gonna pick up and people were really gonna use it so much, and then also its value would go up, then if I was just to buy a coffee, I don't want to, I want to pay what is right for a coffee, then that maybe is 0.00001 of a Bitcoin. So yeah, you have 8 places after the digit, so it's really not a problem that there's only 21 million compared with the trillions of base money out there. Transfers take between 30 and 60 minutes to confirm, and this is a big challenge and a big, this is the fact that this database is not kept in any one place makes it great, because nobody can prevent you from opening a wallet. Nobody can prevent you from sending your bitcoins to any wallet that you wish. And nobody can, delete the entire history or manipulate it by sending all the bitcoins, getting into this file and sending all the bitcoins from everyone else to only his wallet. Anyways, if that would happen, Bitcoin price would go to next to 0, because these things would be totally useless. Nobody would want to buy these bitcoins from him after he stole all the bitcoins from the world. It's just an example. But that is also the pitfall of this system, that it cannot really accommodate the amount of transactions per second that the world is currently conducting. So there is so and so amount of transactions per second or per day that takes place using our credit cards and our online payments to each other in fiat currency. And if there was an equal amount of transactions taking place in Bitcoin, then because the file is kept on several servers, and there is this unique kind of technological innovation to make sure that it all gets updated at the same time and not like some files get updated with some transactions and other files get updated with other transactions which are not consistent with each other, and the whole thing will get fudged up, then that's what also makes it a lot slower and not able to accommodate so many transactions like the world is actually transacting. Okay? So a central database is much more efficient technologically in how many transactions it can process than a distributed ledger. And that's kind of a fact of physics. Okay, this is from the laws of the universe. I don't want to offend any hardcore Bitcoin computer scientist that has the kind of technological solution to scale Bitcoin, but I understood and I understand that it will always be more expensive to for a given amount of transactions. Let's say, I don't know, for a given amount of transactions per second, it would be more expensive and slower to have all these payments on the blockchain as opposed to be having them on the central bank one database. Just because, yeah.
Isn't there also a problem with the electricity needed for all these transactions? Like if we would
yeah.
be worried about the electricity, we wouldn't have enough.
Maybe. So it's also energy consuming. It's also energy intensive. This technological way to make sure that there is no inconsistency between the different files also involves solving a very complicated computer problem. It's actually a very simple computer problem, but it takes a lot of resources to solve it. I don't know, it's like multiplying a big number with a big number. So it's not really a complicated thing to do, but it takes a lot of computer power, and therefore it takes also a lot of electricity. So that's part of the technological solution to make sure that if I make a transaction, then all of the files would reflect this transaction before they can reflect the next transaction. This has something in its core that's called that's a very computationally intensive but very simple to prove the right answer mathematical problem. Okay, and that is one of the problems. That already at this stage it's fairly expensive to keep this whole thing running, but really not as expensive as the media portrayed it to be. So when Bitcoin was really going up, then the media was coming up with everything that they can come up with to say, well, this is not gonna be sustainable. So a lot of it is kind of biased, but yeah, it's true that the amount of electricity resources and computational resources that this thing consumes, even at still a small size relative to what the world really wants to transact with each other, is high. And so let's see if this thing really picks up. And you can read about this here. So this process is called mining. This kind of solving of a very intensive but simple problem, like multiplying two huge numbers with each other. This is kind of at the heart of the technological solution to make sure that all the files reflect my transaction now before they reflect the next transaction. And that process is called mining. And if we jump to first-time distribution, you guys should ask me, well, how did this thing start? We got to 17 million, but we started at zero. How did you first time give out these 17 million Bitcoins? Okay, or whatever number you started with. How you distributed this first time. So I've explained to you how this worked with fiat currency. And with Bitcoin, it works slightly different. So the first bitcoins and new bitcoins as they are created to bring us to this total amount of 17 million going on 21 million, they were given as a reward to these computers that are solving this big computational problem to make sure that transactions are correctly reflected on all of these files and that there is no inconsistency or double spend. Okay? So for them to invest all this computational power and electricity and to do anything to get out of bed, okay, they were awarded with uncertainty, but if you do enough of these, you get a pretty certain average reward in bitcoins. So it was in the beginning, I think 50 bitcoins were awarded for the block processor, the block miner. Okay, and the block contained about 1,000 or so transactions between wallets. And then whoever solved this computationally intensive problem to make sure that it's correctly reflected all over the internet got those 50 bitcoins. Okay? And then the amount of bitcoins went down by half to 25 bitcoins reward, and then by half again to 12.5 bitcoins, and it will half again, and that's why it looks like so. It's, I don't have it here, but it's gonna converge to 21 million. And what about transaction fees? So this Bitcoin reward was sufficient in the beginning to incentivize these miners to invest in building up this mining farms and to solve these computationally intensive but simple problems and consume all this electricity, because that reward was valuable enough, but and it still is. But going forward, as most of the bitcoins will already be out, and it will be not 50 but 25, not 25 but 12.5, not 12.5 but 675, 625 bitcoins reward. It goes lower and lower until it practically goes to zero. Then what would incentivize these miners to process transactions and to expend all these computational and electricity expenses? That would have to be from the processing fees or commissions attached to each transfer. So in addition to which wallet I'm sending my bitcoins to, there is also another field. This wallet service provider doesn't let me edit it. They just kind of do it on the back end for me. But I can decide here if I want to attach a 0.001 Bitcoin as an additional compensation to whichever miner in the world which is going to pick this block up and process it. And then in addition to the block reward, he would get also my fees. Okay? And that's an additional incentive for these miners to expend their electricity and computing resources to process my transaction in the blockchain way, in a consistent way that is reflected all over the web. Okay, some additional features is there's no central control of the ledger. Transactions are irreversible. Okay, there's nobody to call and say, "Oh, I made this by mistake. Just reverse it." Accounts cannot be frozen. Okay, if I have the private wallet, the private key to my wallet, I can access this from any computer, and there's nobody that can stop me. They would have to really lock me up and take me away from a computer or take away the private key from me for me to not be able to transact. The amount of bitcoins in each wallet I've shown you is public, and also the history of transactions is public. Okay, so you can go into one of these website that make it easier for you to interact with this 8 gigabyte or so file, because you maybe are not so computer savvy to be able to see it directly from the file, but you're computer savvy enough to log in here and they interact with the file for you. They're already presented for you online in a way that you can easily understand, and you can see the entire history of transactions from this given wallet. So this wallet currently has 219 bitcoins, and it received in total 34,000 bitcoins, and therefore it also sent out the difference. And then you can see the entire history of bitcoins coming into this wallet and going out of this wallet. And then you can click this and go to this address. See, this is the address that we're talking about. So this address sent 0.12 bitcoins in 2017. And then you can ask yourself, well, what's this address? And you can click this address and see all the Bitcoin, all the transactions that ever came in and out of this address. Now you don't have the names, so you don't know who's owned this, but the thing is public. So keep that in mind. I'm going to ask you a question about this. Like, what happens if I manage to get into your computer and take your private key, and you've had Bitcoins on there, and then I was able to log in to access your wallet and issue an outgoing payment to my wallet? You'd be able to click to enter your address on here and see exactly which wallet I sent this to. Okay, but you would, yeah.
But even if the address, so if your address would be public and we would know that it's the address of Avi, by law you couldn't enforce, also I couldn't enforce you to
No,
return
sure you
money.
can, sure you can. You can file, you go to the police,
Yes.
file a complaint, you show your evidence, and they will invite me for a Vorladung, and this we can go to court, or this can be solved even before it goes to court by the Stadtanwalt. Yeah, this would be a criminal offense, and if you have evidence that it's really me, then you can go take me to court. You can go to police.
But the problem most of the time is that you don't know that it's
That's the problem,
Yeah.
is that you wouldn't know that this wallet it went to would be mine. Okay? And that's where the kind of interesting part is for you to think about. But what you said is simply not correct. Like if I break into your house and I take your asset, I don't know, your car or whatever, of course that's a criminal offense and you can take it to court. Same thing with Bitcoin. Bitcoin is an asset, legally speaking, it's an asset. So what you said is not good. If I take anything that's yours and you can prove it, you can go to the police, even if it's Bitcoin, for sure. I want you to kind of take this with you, that Bitcoin, because it's in positive net supply, it's an equity asset to its owner. If I have Bitcoins, it's my asset, right? If I have dollars in the bank, it's also my asset. But my Bitcoins are not anyone else's liability, right? Nobody owes me these Bitcoins. They're just simply mine. And therefore, it's an equity asset. So it's an asset on my balance sheet, and it's nobody's liability. But dollars, Swiss francs, pounds, all of these, if I have some in an account, they're my asset, but they are someone else's liability. Even if they are cash, hard cash in my wallet, they are still a liability to the central bank. Okay, so it's a debt asset, meaning that it's my asset and it's someone else's liability. But Bitcoin, gold, trees, okay, anything that is in positive net supply is my asset, and it's an equity asset because it's nobody else's liability. All right, keep that in mind. And that also means that nobody is making interest on my Bitcoin. Nobody is able to utilize my Bitcoins and lend it out for an interest rate that is higher than it's paying me and make money. Okay? Hot versus cold storage. I mean, people have made too much of this. A hot storage is all about where you keep your private keys. Like this 21-digit or so code that with this I can issue payment out of my wallet, and only with this. Where do I keep it? If I keep it on a computer that's connected to the internet and potentially someone can hack this computer, then it means that that it's hot storage. If I'm writing it down and putting it in a safe, it's not even on a computer, that's cold storage. Or if it's on a computer that's not even connected to the internet, nobody can hack it, then that's cold storage. Multi-signature wallets, you can set it up that even so Bitcoin has on the blockchain one wallet, and some other cryptocurrencies have already built in their blockchain that there needs to be more than one private key. Okay, so it's just like when you go to the bank and you need the bank's key and your key, and you need to turn them both at the same time, and only then you can open it. I don't know how old you guys are, but this exists. And people still have like gold and money in safes. So you can set up such a setup. Even with Bitcoin, it would be kind of an overlay solution that, okay, I would have one, and maybe we're partners and we decide to do everything together. Then you would have this one, and I would have one, and to make any Bitcoin go out of our wallet, we would have to have both of the keys inserted. Okay, that would be a multi-signature wallet. And then each key, mine and yours, can be kept either in hot or cold storage. So maybe like for operational purposes, if we're running an exchange, we want one set of keys to always be kept on a computer that's connected to the internet, because it makes things easier to process a lot of transactions. But if we're making big transactions, or if we're sending it out of the exchange, then we want to bring in the one key from cold storage to allow this transaction. Okay, there's different kind of security measures that could be set up. Yeah, but what if someone hacks my computer, or the computer of my wallet provider, and gets access to the private key and connects directly to the blockchain by another wallet provider, or if he's clever enough to do it directly, and then issues a payment out of my wallet into another wallet. Okay? So first thing, it's irreversible. There's nothing I can do in the world other than to really lock him up, get the police involved, to undo this. Only he can undo this, or anyone that has his private keys. It's publicly visible, so I know exactly which wallet has it, but I probably don't know who person this is. Okay. How can he monetize his loot? Okay, he just stole some bitcoins, but he's scared because, let's say it's a lot of bitcoins, and I'm kind of a resourceful person. Then I got the police involved, and I got a private investigator that has expertise in following transactions on the blockchain. So he knows that the eyes are on this wallet. And so how can he use this money now? This wallet has been black labeled now. It's black. It's marked, right? Any ideas here? Let's see who has the criminal mind here. Yeah.
Like maybe you could create like, I don't know, 1,000 or more wallets and
Right.
distribute like 0, 0, 0, whatever,
Yeah.
1 to every wallet,
True.
and do that multiple times.
Yeah. So that's one way, and another way is to mix it up. So, like I showed you here, the exchanges have pooled accounts. So you have to understand there's lots of bitcoins coming in and out of this wallet on kind of a daily basis, because this wallet is for all of the clients of this one exchange. Okay? Then why don't I just send it to the exchange, and then from there I'll send it out, and it'll be mixed. And the answer why I shouldn't, and okay, so this is one way, you kind of mix it up, it's called a mixing, or a mixer. But then the exchanges stepped up their game and said, well, we keep a blacklist of all these wallets which we know contain bitcoins which have been stolen in the past. So we don't accept deposits from these wallets. So you try to send your bitcoins which you stole and which have been reported to any one of the exchanges, and you're not going to see those bitcoins again. Okay, so that's already kind of been shut down for them. But you can find someone online on some bulletin board that is willing to exchange dollars, hard cash. You meet up with him for those bitcoins, and then maybe he's gonna be foolish to accept bitcoins which are tainted. Now he's gonna have the problem, even that he didn't even steal them. Okay? Or maybe someone that's willing to give you another cryptocurrency in exchange for these. And then again, he would have this problem, but maybe you can do this fast enough and nobody kind of is able to trace this. Okay, so it's not simple. And the bigger the amount is and the bigger the fuss that whoever lost the bitcoins makes of this incident, the harder it is to safely monetize the stolen bitcoins. Any questions so far? How are we doing on time? People making noise. Are we almost done? Finished? All right. We finished this next time.